At Dragon Charts, we actually teach people how to trade many different types of markets. We have stock analysis sessions on the Hong Kong market, the Indian market, Indonesian, Philippines, and even the American markets. And the reason for that is because stock markets all basically are the same, meaning that even though the companies are different, the markets are driven by the human emotions of fear and greed. And fear is what makes the market drop when it goes down, and greed is what makes the market go up. And people were the same all over the world, so markets perform similarly, and the patterns that work on stocks in the US market work exactly the same in the Indonesian market or the Hong Kong market or any other market. That's the beauty of this is once you learn our strategy for technical analysis and our strategy for trading, you can apply these concepts to any market that you want to trade. Now I know some of you out there might already be trading, and one of the reasons we started Dragon Charts in the first place is we found that there's a real lack of technology in some of the smaller markets in Asia, such as Indonesia and the Philippines, for example. There's a lack of technology to really help the trader, the individual trader, in terms of stock scanning software and high-tech charting and technical analysis software as well. And Dragon Charts is two things. One is we have our online education, our stock analysis courses, which are pretty much focused at the beginner level, and we do personal mentorship and hand-holding, teaching people our proven winning strategy of trading. But the other thing we have is a scanning platform. It's almost finished development right now. It's probably only going to be about 2 or 3 more weeks, and we're going to be launching this software, which is designed targeted specifically at the Asian market, and it'll give you the capability to do all kinds of scans, saving you time. With a click of a button, you can find the strongest stocks for potential buy entry or stocks that are pulling back within their trend. And this software is actually going to be included for all of our students or available exclusively for those people who are already trading. So that's pretty exciting. That I can't wait for that to come out because it's really going to help our students a lot for finding opportunities for trading. But in the meantime, unfortunately, we're pretty limited with what we can work with in certain markets, in particular Indonesia. We found it actually one of the best, one of the better. I mean, it's not great, but it is free, and it also is better than most of what we've seen out there, and that is Yahoo Finance for doing charting. They enable you to do some basic technical analysis, really basic, but there's no scanning platform, so basically it takes a lot of time to manually go through each stock. So I've saved the time and I've done that ahead of time before our webinar tonight. So tonight we're going to be looking at actually two different stocks that trade on the Indonesian market. The first one is called Energi Mega Persada, and the ticker symbol, as you see here on my screen, is ENRG. And I like this because it's really good from an educational point of view to show you a couple things. First of all, right now we see what's called a consolidation pattern. Consolidation pattern means that the price is trading in a sideways range. You can see here each one of these bars, each one of these candles is 1 day of price action. So basically over the past several weeks, the stock has been trading sideways near its highs, and that's a positive sign when we see that happening, because when it indicates when you see sideways price action that it's typically going to lead to a resumption of the dominant price trend. Let me add one other moving average here. Okay, there we go. So that's what we're looking at here. Now, there's 3 moving averages we typically use. This beige line is called the 20-day exponential moving average. The red line is the 50-day moving average, and the green line is the 200-day moving average. And these are the ones we typically use. These are good indicators of trend. They simply show you what the average price was X number of days ago. And when a stock is healthy and in an uptrend, we like to see this, where the moving averages, we want to see the 20-day moving average above the 50-day and the 50-day above the 200. And they want to be in an upward trend, just like you see here. This is a sign that a stock is trending higher. Notice back here earlier in the year, the moving averages simply kept crossing over each other. There was no trend. They just kept crossing over. But once the trend started to stabilize and move higher, then the moving averages spread out as well. What's interesting here also is you see back here in April, we had that same consolidation pattern I was just talking about. Notice how we had the price go sideways for about 5 weeks, and then one day the stock broke out. That means it moved above the high of this range on this day right here. And look what it coincided with. These are volume bars at the bottom. They show you how many shares the stock is trading. Notice how this day's breakout coincided with a breakout in the volume. The red line you see down here is our average volume. So the volume surged to about 3 times its normal average daily level. And then as the stock began climbing higher and higher, notice how the volume picked up as well. This is one of the most important signals of technical analysis that we teach our students, is looking for volume confirmation. If we see the price go higher but the volume doesn't pick up, that's usually a bad sign. We'll stay away. But in this case, we are seeing the volume actually pick up as the stock moves higher. And notice how this 20-day moving average perfectly acted as support. When the stock moved sideways, the 20-day moving average caught up, and that enabled it to springboard higher. And now we have the same thing happening again. The stock's trading sideways as the 20-day moving averages rises to meet the price. And then what we should see is a resumption of this breakout and a breakout to new highs, corresponding as well with high volume. If we look at the 3-month chart, you can see a little easier. There's a 3-month chart. So you can see it's been consolidating since mid-May, this stock. But what is also interesting is the 1-year chart, because what I'd like to show you here is the price action as it looked before it actually broke out and rose higher. Let's go for a 1-year chart. Notice how we had this sideways action again. Now this is a period of 7 or 8 months from July of 2010 to April, where basically we had what's called resistance. This blue horizontal line you see marks resistance. Notice how back here and here this acted as resistance. So this breakout that we had in April above this consolidation also coincided to a breakout above this horizontal resistance. And that's why the stock is surging higher now. So typically, this is what they call a first stage breakout. It means that the breakout is new. It's still in its first wave up. Typically, strong stocks will have at least 3 waves up before a significant correction. So this is not a stock that we envision as being ready to break its uptrend at any time. Although, of course, anything's possible, and that's why we use stop losses. But we do like this. So keep an eye on this stock. I recommend keeping an eye on it and consider a potential buy entry if it gets above the high of the past several weeks. So you're talking about basically the 210 area, somewhere around there.